Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for Financial Literacy Month, which takes place every April, we have Bob Lang, founder of Explosive Options, to discuss how investors can use puts for protection and why options are cheap when volatility is low. Bob, it is great to see you as always. Welcome back to Trade Talks.
Always good to be with you, Jill. It's great to see you.
You got it. Before we get into the volatility part of the conversation, explain to us how investors use puts for protection.
Well, basically, we've been in the throes of a bear market for about 15 and a half months since the beginning of January. And, bear market rallies have come and gone. We've got 4 or 5 of them already. And basically, when we have bear market rallies, have been great opportunities to buy some puts, especially when puts have become cheap with volatility down in the teens, right where we're at right now, 17, 18%. That means option prices are cheap. So I think buying protection against your long portfolio is certainly a prudent thing to do in regular bull markets, but it's almost imperative, it's almost mandatory to do when you're in a bear market. And we are currently still in a bear market, and a lot of people are talking about the fact that we're out of the bear market now. It's just not happening yet. And, until let's put it this way, Jill, I've never seen a bear market end when the Fed is still raising interest rates. And actually when rates are not at or near the peak. And we have to go by what Chairman Powell said. We're going to have higher rates for longer, and that is going to be an impediment to companies with their earnings down the road. So I still think that we're going to be in a trading range, probably somewhere between about 4,200 on the high side. We're really close to it right now. Downside, maybe 3,800, possibly 3,700. And it's going to be difficult for people to trade that type of market, but having put options is going to help you alleviate some of that excess volatility that can come in here, which is like we had last month.
It's interesting because not many people are saying we are still in a bear market. Look at what the Nasdaq 100 did since the beginning of the year. It seems as if the market has its own narrative and it seems very divorced from what the Fed is saying. They have not changed course. They have not gotten the data points that they're looking for. They're getting better, but we're still not even close to the 2% target. It seems as if it wants one thing without listening to what the Fed is trying to say. I mean, I don't see them reversing course anytime, maybe not raising, but certainly not reversing course.
Yeah, no, I think it's really kind of an odd situation that we're in right now. The market is trying to tell the Fed what to do, and they're telling the Fed that they're wrong. For a long period of time, it was the tail chasing the dog and not the other way around. So a lot of people didn't trust what the Fed was doing, when Bernanke was the head of the Fed, and then we had Janet Yellen, and then now we have Chairman Powell. They don't seem to believe what they want to do, what their goal and objective is, as you said, to get back inflation to around the 2% range. So I think we have to take them for their word, also take them for their actions. They've been pushing interest rates higher in an unprecedented fashion. And in just under 14 months, we've had interest rates go up from zero. Don't forget, 14 months ago, we were at zero, and now we're at almost nearly 5%. So we've never seen interest rates jump that fast, certainly in the last 35, 40 years. So I think we have to take the Fed for what they're saying and for what they're doing. That's more important right now.
I'm glad you brought that up, Bob, because you could think, 5-6%, it's historically low. It's not as high as we saw in the 70s and 80s. But to your point, it's the velocity at which these changes took place that I think have thrown a lot of people off guard, particularly in an environment, let's say the past 12 to 14 years, where there's a generation of traders out there who have not invested in an environment where they're grappling with higher interest rates and there's less liquidity in the system. But I want to go back to earnings for a moment here and other ways that you use options. Even if you look at an individual name, there's a way that you can use options to help you anticipate at least the size of the move to the up or downside options traders are expecting.
Right. So what we do is we look at for an expected move. Here's how I approach earning. Let's take, for instance, tomorrow we have Netflix coming out with their earnings after the close. So I'm looking at what is the expected move, and we can look at that by basically looking at the straddle. What is the straddle? That would be the at the money call and put option. So if I think last I looked, Netflix was trading about $330. Jill, I want to see what is the April 21st, which is this Friday's straddle when you add the call and the put that are at the money. I think it was something around $27, $26, $27. So what does that mean? That's about 8.5%, 9% of the price of the stock, of the underlying. So the stock's at 330, you take $27 divided by that, you get about 9%. So the market is looking for a very large 9% move. Is that big based on historical standards? For Netflix, it's not all that big at all. In fact, we've seen large moves since the last time around. The stock moved about 15% post earnings. So there's a way to capture that move if you want to by buying that straddle. Now, alternatively, you can go out a different way and use what's called a strangle, and you can buy an out of the money call, an out of the money put, and really have a little space in there that you're not going to capture, but still. You can certainly get a big win on that. I mentioned Netflix only because Jill, because it was one of the biggest wins I've ever had in my trading career. About 6 years ago, I bought a strangle on Netflix. Now the stock was trading around where it is right now. I bought a 400 call and a 300 put simultaneously. The stock got drilled the next day. It was down about $100. And obviously the call went to zero. I bought this strangle for about $2.50. I bought several of them, and the put went all the way up to $62. So from $2.50 all the way to $62 in about 24 hours. It was pretty amazing. It was one of the best trades I've made. So that was a way to capture a big move on earnings.
Let's talk about activity in the explosive options community. When you take a look at what the team in the trading room, what they're gravitating towards, is it a specific sector? Is it certain stocks that they frequently trade? Is it more news-based? What are you guys trading in the room?
So I'm pretty agnostic when it comes to stocks. I'm equal opportunity. If there's a stock out there that's going to help me make money, I don't care if it's IBM or Lennar or Procter & Gamble. If it gives me an opportunity to see an options trade and make a win on it, I'm all for it. So I think what we're looking at right now, Jill, is the fact that there's a lot of option prices that are expensive right now, even though volatility is down. So there's a little bit of a disconnect there between the pricing of options and what they should be priced at. So what does that mean? That means when you're going into earnings season like we are right now, take Procter & Gamble, for instance. They come out and report earnings this coming Friday morning. The options are expensive leading up to that earnings season, your earnings report. But if you go out a couple of months further, maybe out to May, possibly out to June, you find that the option pricing is much more normalized. So what I want to do is I want to do what's called a diagonal. And what I want to do is I want to buy the outer month, maybe like a May or a June call, and I want to sell the premium that's coming out for this week or even possibly next week, because the odds are going to favor me. It may not happen exactly the way I want to do it in terms of the timing, but the odds are going to favor me to take in some of that premium and watch that option decay into the next 4 or 5 days. And actually, if I do it for Friday, Jill, it's only a 1-day wait for me to let that option decay. So I want to be able to take advantage of that extremely high implied volatility for that option, because coming into earnings, I think there's a lot of good news that's already baked into stocks like Procter & Gamble, and people are bidding these things up, thinking they're going to continue to go higher. I just don't think it's going to be the case.
All right, Bob, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.